Hello, everyone, and welcome back to another episode of Spark Your Fire special episode. We love webinars. We've done kind of like a few webinars, and last time, I'd say around August last year, John, we did this. We discussed about this topic on whether real estate is too expensive now, which I thought was a very, very interesting topic. And we've had really positive feedback from that video, and based on very popular demand, they've requested John to update the figures and tell us where are things at today, given the fact that it's about 6 months since we've had the latest updates. So here we are. You can classify this as is real estate too expensive part two, or even looking at it, John, I reckon this kind of data set is interesting enough for us to be able to actually provide an update maybe every 6 months just to see that trend. Because I reckon it will give our viewers a really, really good understanding and idea about where value is currently at across the cities. Anyway, how are you doing, mate? You good?
Look, I'm great. I'm very good. Thank you for asking. Good to see you. And yeah, look, it's very interesting that we've got a really long-term data set. So we go through data that goes back to the 1970s, and normally waiting 6 months is almost a statistical rounding error. Like, it's not enough of a move in the data to see anything meaningful. The interesting thing this time is that the property market has moved so sharply that actually you see big changes in what is a very long-term data set that's quite meaningful. So we've got lots of interesting stuff to say.
Awesome. Now, looking forward to it, John, and I'm sure so too are our viewers. So without any further ado, can I leave it over to you, and let's kick off.
All right, let's do it. So I'm going to start with a property update, a national property update, but a little bit of a bias towards Sydney. And so really quickly, we've seen, and this is obviously no surprise to our listeners, this data goes up to January. All the data goes up to January, but Sydney prices nationally are down about 9% over the last 12 months. But Sydney is down 14%. Now, Sydney corrected first and therefore the most, but the cycle's not over yet. So Sydney's property market correction started in about January, February last year. So it really did last the calendar year. Whereas if you take most of the capital cities, Brisbane, Adelaide, most of the other capitals, excluding Melbourne, they started correcting in July. And so when you look at the data, they've had heavier falls in the later quarters, but the annualized numbers don't look so bad. Sydney looks the worst because it corrected the first and the deepest. And for context, actually, to tease this out a little bit more, this has been a historical decline, this 2022 decline, again, nationally down about 9%, but also the hardest, the fastest, the shortest, the deepest correction, at least since this is CoreLogic data. CoreLogic data began in the 1980s. So very, very sharp decline. But for context, and context is always important, the 18 months leading up to 2022 saw the sharpest, fastest, quickest increase in property prices. So the 18 months leading up to 2022, property prices nationally were up 29%, which is staggering. So the market needed to blow off some steam, to blow off some economic energy, but we haven't given it all back yet. Now, all the capitals are still higher than their pre-COVID levels, with one exception, and that is it's about to be Melbourne. So Melbourne next month should dip below its pre-COVID levels, but all the other capitals are still above the COVID levels. Now, what we're seeing, we've seen a bit of a collapse in demand. Demand's down about 50%. But we're also seeing a collapse in supply. So supply has been down about 30% in Sydney. And so supply in real estate terms, and real estate's different to other assets, because when the stock market declines, it can only decline in terms of price. But when real estate declines, supply comes out of the market, people stop selling, and that supply reduction becomes a bit of a shock absorber. So we're seeing prices decline after a big increase. Now, interestingly, and I was just looking at the CoreLogic data this morning, it's the fifth day in a row where Sydney prices are increasing. So it's only February, and the market's got a long way to go, but prices seem to be bouncing up a little bit. Now, before I go into this chart, this is really interesting. But David, any comments so far?
Look, no, I think it's a great summary in terms of where we are, and I think it gives our viewers a bit of context in terms of where Sydney market is, and as well as in comparison to national markets. Now, with this chart, interesting enough, for anyone who was interested, back in August last year when we released this, we also had exactly the same chart, except it went up to probably around the 7th of January or even December, actually, 2022 December. So we literally just at the final kind of like the tip towards going back down at that point. And for context, gold is priced at 523 ounces at that point in time, whereas now for this chart, it's now 435. So there has been quite a significant reduction in that. And as a summary from our previous video, at that point in time, Sydney is 10% above all-time average and 15% below its average price this century. Okay, so that was essentially where we were situated around August last year, I believe. So now that we've got a lot more data, I'm sure, John, you could extrapolate that and give us further updates.
Yeah, I'll give you. It's not obviously intuitive, this chart, so I'll give you a bit of an update. But the message when we put this out based on 6 or 7 months ago was that yes, Sydney house prices are overvalued, but we're not in the bubble that everyone thinks they're in. They're overvalued. Prices are going to come down, but it's not the big bubble that was certainly being discussed in the media. Now, this is the price of real estate priced in units of gold. Why do we use gold? Because gold is money. I think J.P. Morgan, the man, said in 1908, gold is money, everything else is credit. And he's right. So the dollars, that what we don't want to do is measure anything over long periods of time using national currencies. And you ask anyone in Zimbabwe or Argentina or Venezuela, countries that generally don't trust their national currencies because they lose value, you need to measure it in something that holds its value since 1979 in this case. And generally speaking, the monetary anchor that you can use to measure things over long periods of time that doesn't suffer from a phenomenon called inflation is gold. Gold is money. It's the same value for thousands of years. And so you can measure things in it. It's like when they say, John, what's your height? And I say it's 6 foot. And I use a tape measure that keeps growing. And next week I'm 7 foot. Like that's what measuring real estate in dollars is. You want to measure it in gold because gold doesn't change value.
I would love that analogy, John. I would love to tell my mum and dad that I keep growing every couple of centimeters every month.
Yeah, so I mean, this is getting very strange. The ruler analogy, but yes, that's right. So what we can see is when you measure stuff with stuff as opposed to stuff with dollars, paper currencies, you see that actually, rather than just going up every year, what's actually happening is everything is trapped in a valuation channel, and it goes to overvalued, then undervalued, then overvalued and undervalued. But most things are trapped in a valuation channel, and real estate, generally speaking, is trapped in a valuation channel between being worth 600 ounces to 400 ounces. So when it gets to 400 ounces to buy a median family home in Sydney, you know that real estate's cheap. And when it gets to 600 ounces, which is this bar here, real estate starts to look expensive. And in some rare cases, you get these insane blow-off overvaluations where it got to 1,000 ounces to buy a house. But that's very unusual. And that came off the Sydney Olympics. It also came off, it was just straight after the tech bubble and where they lowered interest rates, but that's unusual. 2008, property market crash bottomed out at 400 ounces, and so did 2020 after the COVID crash. Now, the point of this slide is that it never got into a hyper bubble. Real estate was always overvalued because it was up at this 600 ounce level in Sydney, but it didn't get into a hyper bubble. The media said it was in a hyper bubble, but it wasn't. It just moved very quickly. We're getting back down to 400 ounces. And my takeaway from this is that Sydney hasn't bottomed yet. It's gonna it's going to continue to go down for a little bit longer. But we are probably close to a bottom. Now, I hate picking tops and bottoms, but we're certainly at a threshold in terms of this ratio, which is actually very predictive, to suggest that we might be bottoming out anecdotally, and we can see in the core logic data and the clearance rates, they're all going up. So it's quite possible that we're near a bottom. I wouldn't say we're at the bottom yet, but prices are certainly less expensive and close to 2008 levels in real prices.
And that corresponds to the latest January core logic data on the hedonic index, isn't it? Because the reduction or the magnitude of the reduction is certainly slowing at the moment. So that kind of indicates, if you're comparing to this graph, probably anecdotally starting to turn around or swing around thereabouts again. So no, it is interesting. I think I do agree with you that we are starting to see that might not necessarily be the bottom yet, as you say, but we are moving more towards a stabilization phase. More so, it's not going to go back up quickly, because I don't think that certainly they're not going to drop interest rates so quickly, because inflation is never being under control. APRA is not going to loosen the assessment buffer yet, because again, inflation hasn't been under control. So we are probably looking more like a prolonged flat line, as per se, for a bit of period.
Yeah. So certainly, like upper quartile, sort of more expensive areas seem to have bottomed. They certainly fell first and fell sharpest. That part of the market seems to have stabilized, but there's no supply at the moment. So the prices aren't coming down. Last thing to say on this slide is that it's always possible that it'll break through 400 ounces. It briefly did in 2020. But I don't really expect prices to go below that 400 ounces to this 200 ounce level. The reason for that is the last time it was there, it was the early 80s, the late 70s. The banking sector has since been deregulated. They can turn the taps on for credit. Our property sizes are bigger. I just don't expect it to break below the 400 ounce period unless there's a systemic change in our property market. So I just don't expect that. All right. Let's do something interesting here. Let's compare the capital cities. So we've established that Sydney is it's still in a correction mode, but it is at the lower end of its range. It's close to that 400 ounces rather than the 600 ounce, where we know it's more overvalued. But how do the other capital cities stack up? Now, the last time we did this, we said, I think we showed Sydney to Brisbane ratio.
That's right. Sydney to Brisbane, Sydney to Perth, I think was the other one. Yep.
That's right. And we said that Brisbane was overvalued and Brisbane was going to underperform Sydney for the next couple of quarters. And that's exactly what happened. But actually, what has surprised me is it's corrected so quickly. I mean, we go back to that first slide of the market. It's a very sharp correction. So all these ratios are rebalancing very quickly. So Brisbane is still more expensive than Sydney, but it's not ridiculously overvalued, actually. I'd expect over the next couple of quarters, Sydney to continue to outperform Brisbane, but surprisingly, Brisbane's holding up, and its correction has been very rapid. So we're seeing, Brisbane always tracks between about 140. Sydney is always 140 to 100, let's say 80 or 200% more expensive than Brisbane, and it's at about 155%. So it's kind of at that range. Brisbane's a little bit more expensive than Sydney right now.
Funny enough, John, before you move on to that, I was looking at the video that we did last year. I think around August, around that period, Sydney is also about 155% medium to Brisbane. So we literally dipped below the 150% mark, and then came back up again. And I think my interpretation of that is because Brisbane is dropping a lot faster in terms of the magnitude at the moment in comparison to Sydney, right? So the Brisbane might be dropping at 2% something, where Sydney was at 1%, and that cumulative effect is now starting to invert the graph, and that's why all of a sudden Sydney started to become a bit more expensive again,
Yeah,
even.
that's right.
So
No, that's absolutely right. Look, we're going to, and just for context, we're going to go through the overvalued capitals first,
yep.
and then we'll do where the cheap locations are.
Okay.
Canberra is also slightly overvalued, but it's not obscene. So it always sort of bounces between in a valuation channel, and that's why looking at relative values is far more informative than looking at absolute. What's the price of something? So this analysis again asks, what's the value, not what's the price. We know what the price is, but we don't know what the value is. Here we can see, below that trend line, generally speaking, means Canberra's expensive compared to Sydney, but we can also see that's starting to correct. So Canberra, that line should start to bounce up because it's bounced off 120%, and Sydney should revert back to what might be an overvalued scenario of about 160% of an average Canberra property. So it should move in Sydney's favour compared to Canberra. Adelaide had a big correction. I mean, markets are like a weighing machine, So Adelaide had spent a lot of time being undervalued, and it corrected. Now Adelaide is slightly overvalued, but Adelaide is not. It's not insanely overvalued, but it is overvalued compared to Sydney. So it looks like it almost still wants to move in favour of Adelaide. The trend still seems to be with Adelaide. It doesn't seem like it's bouncing yet. So it'll probably move down to 150%. So I think it's a bit of a warning sign in Adelaide that I think it'll get overvalued before it gets undervalued. But
what I'm hearing, that's definitely the case, John. On the ground, I think Adelaide's still very heated, just like Perth at the moment.
Yeah, it doesn't look like it's going to stop, does it?
No.
But then look, but again, we need to watch this. It'll get to, let's say, 150, 160%, and then you kind of want to, you want to be careful in Adelaide when that happens. But it's not obscenely overvalued, but it is more expensive by historical standards than Sydney is at the moment. Now, the most overvalued capital is Hobart. A lot of buyers agents were the national buyers agents were quite rightly back in 2017, 2016 identified Hobart as undervalued, and that's right. I think the main attraction was actually the rental yield, but a lot of that money has become quite hot, and we can see that Hobart's bottomed out at this sort of 160% value, and Sydney should significantly outperform Hobart over the next year or two. So Hobart is the most overvalued capital according to this measure. Although the way I probably should say it is Hobart is the most relatively overvalued capital at the moment. That is the clearest chart so far. That's not moderately overvalued. That's quite overvalued in Hobart.
What's the average? What's the average medium here in comparison to the Hobart? So Sydney to Hobart.
It'd be about 210%.
210, is it?
Yeah. So it'd be about there.
It'll be about there. Yeah. Okay. So yeah, clearly at the moment, Hobart's still way overvalued.
Yeah.
And it's dropping. And it's like we can tell from the CoreLogic data, it's dropping. It's free falling, just like Brisbane at the moment in Hobart.
Right. Yep. And look, as we've seen, these things can happen very quickly too. Where are the undervalued capitals? Again, we're using. So this is unfairly elevates Sydney to anchor status, but interestingly, so this is all comparing things to Sydney. But remember, we compared Sydney to gold earlier. Melbourne is marginally undervalued. So if we look at the Sydney to Melbourne ratio, it's slightly above that trend line, although it's mostly neutral. I mean, Sydney and Melbourne largely track each other, but right now it's about 140% or just under. Melbourne's probably it's slightly cheaper than Sydney by historical standards, but it could go either way, and very, very close to the mean there. So Melbourne probably the least undervalued. Now we're starting to get into some very significant capital cities of undervaluation. Now, Perth is significantly undervalued. We did say this in the last meeting or the last one webinar, and I think it was up here somewhere about 6 months ago, or maybe a little bit down here. Perth is the cheapest capital. Darwin is as well, as we'll see in a moment. But there's a lot of steam to blow off. I think we said 6 months ago that there's probably 30% upside in Perth. And I think that's still reasonable. So Perth is still relatively overvalued. Very, very volatile market, though, tied into commodities. So it's going to swing. But you would expect there would be a period of time, if there was a commodities boom, that in the next couple of years, potentially, Perth could get to parity with Sydney or close to.
Yeah, last time I was just looking at it. I think last time we were literally just at around the 240 mark. Right. Basically, it was just started to turn. It just started to turn, and at that point in time, the conclusion is that Perth is about 31% undervalued in comparison to the history. Whereas now, you can clearly tell it started to swing back because there's a lot of investors flooding into the Perth market due to, as they can see, the value.
Yeah.
That's why it started to bring into more of a historical average in that sense. So
yeah, that's right. And look, this data set goes to 1990, so there's a bit of a disadvantage. Like the Sydney and Melbourne data sets, particularly Melbourne, goes back into the mid 70s, and so that data set's really solid. Some of the smaller capitals, the data set goes back to 1990, and it's a bit less reliable. But that's interesting. So Perth is very undervalued, but Darwin is as or slightly more undervalued compared to Sydney. So here we've got it above this trend line in the Sydney overvalued section. And again, you'd expect it to come down here to 150% or 140%, and then go back up to 250% over the next couple of years. So in terms of trends, Perth and Darwin look like they're going to outperform the other capitals, and for good reason. That they are relatively inexpensive. You just need to watch your cycles there. And that's it. That's all the capitals. So if I just to summarize in my own mind, the most overvalued is Hobart, I think. Followed by probably Adelaide, but only by a little bit. And the most undervalued is Perth and Darwin.
Perth and Darwin, yeah. I think that gives a bit of good perspective for investors in terms of where the money will be working hardest for them in the current market. But having said that, Sydney is also, I guess, a city that we've all been keeping an eye on as well. And it looks like we are almost at the 400-ounce line as well, which, looking at by historical means, that could potentially be the bottom of the market. Not that we're trying to time it, but essentially, the message there is we may not necessarily be that far away from the bottom of the Sydney market. So for those of people who is looking at entering the Sydney market, now is probably a good time to be able to get prepared themselves for that kind of stuff. So no.
What just a footnote to add, we talked about how fast prices have moved, and these ratios are correcting very quickly. And actually, that's what you want. You don't want these long drawn out corrections like 2004 to 2013. You want nice sharp corrections so you can get on with your life and start making investment decisions again. One of the other things that has changed very quickly, that's also contributed to a rebalancing of property's attractiveness or lack of attractiveness, as the case may be, is how fast rents are going up. So rents are going up by 15%. Now, investors watch yields, and if prices are falling quickly and rents are rising quickly, the market is very quickly rebalanced for the higher interest rates and for scarcity of properties and all that sort of stuff. So another factor that's changed very quickly, that's making real estate look maybe cheap now or less overvalued, is also the high rents. So they're all converging to sort of back up that gold chart, which says that we're at the bottom of the range or we're getting close to it.
Yep.
So rents are a big factor too.
No, definitely. No, very good. Thanks, John. Look, I think, like I said, I actually think that this is proving to be valuable, especially for investors wondering where the dollar is going to be working hardest for them in the current market. And, where should they be looking at, which city, from a very holistic level. And like I said, the paper, if you compare something with the paper currency side of things, due to the inflation, that's not necessarily the best way in terms of comparing. And using Sydney as an anchor in this scenario, or basically we still anchored it against gold, in that sense, at least be able to provide people a bit of perspectives in terms of where each of the cities are from an undervalue or overvalue perspective. So, John, I do think that we should probably do this pretty much every 6 months, just to keep people updated, because I reckon they will be interested, especially property investors as such. Owner occupiers less so. If they need to buy something, they need to buy something, they need to move. So now, one thing, do you see any correlations with the interest rates against these ratios? That might be just something out of the blue, but I was wondering.
Well, interest rates affect all asset classes, and it affects real estate probably more than lots of other asset classes, because real estate's more interest rate sensitive. But these are just affordability benchmarks. We learned over the last couple of years that one of the old affordability benchmarks that a lot of sort of the media use is comparing real estate to income. But when you slash interest rates, that no longer becomes a useful measure, because it's all based on affordability. So what this stuff does is talk about the relative, how relatively expensive or inexpensive real estate is to other real estate or to other assets. Now, the Dow Jones is affected by interest rates. So are bonds and stocks and cryptocurrencies and all that sort of stuff. But gold sort of evens out all that noise. So it's for me, it's the best way to look at relative valuation. Also, gold is the only money on the planet, really. It's definitely a monetary asset. So
yeah, awesome. Okay, awesome. Look, thanks, John. I think we want to keep this short and sharp. But look, if anyone's got any questions, how do they get in touch with you, John? What's the best way if they got any questions about these stuff?
Oh, well, my website is www.bridgetobricks.com.au, and there's a way to get in touch with me from there.
Awesome. All right. Sounds good, mate. Thanks, John. And look, thank you, listeners and viewers, whoever and however you are consuming the content today. We strongly recommend you to obviously watch this as a video because of the slides. If you're just listening to the contents, it may not necessarily make that much sense, but coupling with the slides and what you see on the screen, it will make perfect sense. So, yeah, look, we will probably be doing more of these moving forward, just to keep everyone informed. But in the meantime, let us know if you got any questions. And until next time, we will see you again in another episode of Spark Your Fire. Cheers, John and David.